Greetings, I'm Keith Klein, the host of the VentureFizz podcast, where I interview the most fascinating people in the tech scene. This is episode 413, and today's guest is Scott Savitz, founder and managing partner of Data Point Capital, and founder and former CEO of Shoebuy.com, which is now known as Shoes.com. In my opinion, Boston doesn't give itself enough credit, especially when it comes to consumer brands. It's the home to consumer icons like Bose, SharkNinja, Dunkin, TJX, and so many others. But if you look deeper at the footwear category, it is even a larger powerhouse with leading brands like New Balance, Converse, Sperry, Keds, Rockport, and next generation companies like NoBull, Oofos, and BRUNT. So maybe it comes as no surprise that one of the first companies to sell footwear online was headquartered in Boston, and yes, that is Shoebuy. This was back in 1999 when buying shoes was not even a thing, and even Zappos was just getting started. Thus, I was excited to break down this major e-commerce success story that completely disrupted an industry on so many different levels. Today, Scott is a venture capitalist, and his firm, Data Point Capital, invests in revenue stage technology companies across both B2B and B2C categories. The firm's portfolio includes companies like DraftKings, Rent the Runway, Resident, Black Kite, Jebbit, and others. In this episode of our podcast, we cover lots of great topics, like Scott's background story and early professional experience in the mortgage and banking industry, what it was like building a company in the early days of e-commerce and ignoring the naysayers, how Shoebuy won over the brands, and the details about their, at the time, innovative virtual inventory model, strategies around customer acquisition combined with a focus on capital efficiency to scale the business, the story of the acquisition to IAC, what led Scott down the path of starting Data Point Capital, and what they are targeting for investments, and so much more. Okay, quick side note. If you are listening to this podcast, then it is highly likely that you are interested in the founder journey and all the lessons learned around building companies. So please make sure you don't miss any future episodes by subscribing to the VentureFizz podcast on iTunes, Spotify, YouTube, or SoundCloud. Oh, and while you're there, don't forget to leave us a review. It does really help us out. All right, without further ado, here's my interview with Scott. Scott, thanks so much for joining us.
Thanks for having me.
I'm excited to talk to you. I'm a Boston historian for the whole tech industry, and this is one I remember meeting you at a party and just being like, Scott, we got to talk about Shoebuy and the history of the company because it is such a critical part of what we all take for granted now. So we're going to talk all about the background story of Shoebuy, but one of the things that I've just been like, just curious to know about for years, just because I'm always traveling the Boston industry at large, not just tech. And I noticed there's an incredible amount of shoes and sneaker companies collectively in the Boston, New England ecosystem. Why?
Yeah, a lot of people don't know, but that I wish I could say was fashion in like New York or something else, but New England was home to a lot of the biggest tanneries. That's why you had so many iconic brands that were born out of Massachusetts, your Rockports and your Sperrys and Aldens and a series of others.
There's so many. I mean, you got the big Converse building in Boston and,
Yep, Converse, Saucony, Reebok, but that's why. Tanneries are obviously not part of the process like they were back in the day, but that's why you have so many brands that are based or started outside of out of Boston.
Well, it makes sense now. So now I understand why does this foundation layer exist. So it totally makes sense. And then you have the domain experience of people that built shoe companies, and then others kind of generate off of those, or they need the executive talent that has experience building shoe companies. So it makes sense. Okay, well, let's talk about your background story. So where did you grow up? What were you like as a child?
Well, I think if you speak to my family or any friends or colleagues, et cetera, I probably am not much different now. So I'm kind of a big kid. But I grew up in Weston, which was a small suburb, small town just outside of Boston, as you may know. Was a pretty wealthy town, and my family had very little money, so I was probably if I recall, a pretty scrappy kid in terms of working from a very early age and and trying to make some money, etc. But otherwise, personality-wise, I don't think I'm much different.
Okay. And then what brought you to the University of Colorado to study English?
I actually went out there so again, I grew up in a small town, but went out there with a series of people from um, my town that I was friendly with and just thought it would be a really fun adventure. So can't say that there was more to the story than that. Just a really beautiful place. As it turned out, it ended up being an amazing education and experience. Um, but choice-wise, I think it was more the fun of trying a new location and such a fun setting, etc.
Were you there when they had like a Heisman running back there, didn't they?
Yeah, so I was there during a really fun period. When I was a freshman, we surprised everybody and beat Nebraska. That was a really big deal. And then all of a sudden ended up going to two Orange Bowls. One of our chemistry professors won the Nobel Prize. We had just a lot of really fun things that happened during the period I was there. But the Orange Bowls were a lot of fun.
All right, so how'd you get your career started?
So, um, well, I did a company to help put myself through school that was in that did telemarketing and um, political fundraising and some other things. Really, just a lot of college kids that were smiling and dialing. Since you could get very cheap labor and much more educated labor than you would typically get for $5 an hour. I was actually a poli-sci major. I ended up through that experience deciding I did not like politics and switching to be an English major. But coming out of school, one of the one of the thoughts from doing that business was potentially seeing if we could um, generate leads for mortgage companies. And I ended up, when I was, I think, 21, going into the mortgage business on my own, and that ended up being extremely transformational. Being somebody that came out of college with a lot of student loans, et cetera, and then fortunately having a business that ended up taking off really fast. I did about $100 million in mortgages in my first year of being in the mortgage business. So, and that actually led me into ending up going into banking, which I worked for Bank Boston Robertson Stevens before I did Shoebuy. So strange dots, but they connect for me.
Well, gee, great foundational experience. Obviously, now hearing your story, um, you know, it's one of those experiences that I think everyone should go through, but it's not going to happen just based on the world now, is cold calling people. Like, like cold calling's that lost art that just, if you can successfully do that, you're probably going to be successful doing almost anything.
Yeah, plus everything else will seem very easy.
Yeah.
And but you've been hung up on enough times. But I don't disagree.
And then, so the mortgage business, you learned a ton there. And then, like, what was the role at Bank Boston? Was that still doing mortgages, like through
Yeah,
the
so I worked
bank?
on the trading floor, but the I got very into the bond market, et cetera, with the mortgage business. I won't bore anybody with that, but I did a couple sort of not even unbelievably scientific, but a couple innovative things in the mortgage business that really took hold and really pulled me into bond market and everything that sort of impacted the bond market, and ended up getting recruited by a series of banks, one of them being Bank Boston Robertson Stevens, and worked on a trading floor. And I was there for about 5.5 years and had a really wonderful run there. I think I had about $6 billion in outstanding investments and a lot of very fun accounts, and started with a lot of cold calling, but ended up being a really big business.
Okay, so this is fascinating because I didn't know this background story to this degree. Yet you decide to then go build a startup after you've built this foundation of a very successful business to then say, hey, one of my colleagues, Craig, right, that you met at the bank.
Yep. Yes. So Craig ran a very big part of the bank and a big part of the trading business at Bank Boston, and we did a lot of sort of very unique deals together in different structures. And out of left field, I think if I recall correctly, Craig went online to buy footwear for his family or himself, and had a terrible experience and was like, I can't believe nobody's doing this on the internet. And I had originally gone to Bank Boston Robert Stevens, which I loved, but I went there because I felt like, having worked on my own, that I wouldn't be so self-competitive. It'd be fun to compete against others. As I found out, you never really, your DNA is your DNA. So I think I felt like maybe I had one more in me. And on that thought, and speaking with Craig when he who ended up being my co-founder at Shoebuy, I thought it was a terrible idea. But out of respect for him, I spent a little bit more time with it, and everything that popped up that would have been easy to say, there is no opportunity here. Weirdly, I had one of these light bulb moments that everything that everybody would have hated, I actually felt presented a pretty amazing opportunity. And that's where we came up with the business model, which was really the key. And frankly, it was that in the footwear business, whether you're in wholesale or retail, you can't make money at 100% markup, what they call keystone. I mean, obviously there's footwear brands and retailers that do extremely well, but they struggle, and it's a really difficult industry because of unsold inventory and salespeople expense and warehouse expense. And it's such a fickle business and seasonal and trendy and customer behaviors. But I looked at it and sort of said, if we could do what everybody's sort of talked about with the internet and be totally virtual, if we were to hold no inventory. So the inventory to me was the common denominator amongst all these things that made the business, made such a business or industry so difficult. We could be able to offer the largest selection at the most competitive prices in the most convenient manner. Because when you're getting much better operating margins and cash flow and profitability, then you can offer all the things like free shipping and free return shipping and 24-hour customer service and all these other things. And you really are able to, instead of pushing inventory, you're able to really base everything around the customer behavior. And put together a team, and we were going to self-fund it. 6 months later, I ended up leaving Big Boston Roberts and Stevens because I realized, one, you can't do these things halfway. I was working all night and then being at the bank all day. But then also under Section 27 with Bank Boston Roberts and Stevens, I would have been conflicted on raising money. And we obviously want to raise a little bit of capital too. So I left and joined formally as CEO, I think around January 2000, and the rest is sort of history.
Right. Okay. So this is 1999 originally, before you joined full time in 2000. It wasn't commonplace to buy many things. I mean, Amazon was there, but it wasn't the whole selection of the world at your fingertips. I'm sure you had a lot of naysayers saying like, no one's going to buy sneakers, shoes online. Like, they have to go to the store and try them, like put them in, walk around, look in those little mirrors, like get their, get size, right? Make sure it's the right fit. And Zappos wasn't around just yet. I mean, they were originally called shoesite.com from my research, but you guys like launched around the same time. So it wasn't like this thing that really existed. And this is where, Boston doesn't get enough credit for some of these groundbreaking ideas.
Yeah, it ended up being a super, super fun business, but everybody hated the idea. And I will say there was one sort of data point where I would have felt it was not so non-intuitive even though people mostly would not have been aware of it, but it was about 5% that was being sold already through catalogs. And that was about $2 billion in footwear being purchased a year without trying them on. And what I didn't even think was a very scalable market. So people were buying footwear without trying them on, but people thought it was a terrible idea. They would never buy footwear without doing it themselves in the store. And we had certainly a lot of naysayers. There was no question. And the shoe site was started a couple of years before us. And the founder, a founder, Nick Swarmer, and Tony Shea, who a lot of people know the name, was an investor ultimately in Shoesite, changed the name to Zappos, and really ended up just being an unbelievably genius entrepreneur. And interestingly, for whatever it's worth, there was very, very few people doing it. We had competitors, almost everybody went away, but people always sort of pitted Zappos against Shoebuy. Zappos was a lot bigger. Ironically, we were extremely friendly and close. Actually miss Tony a lot. He's since passed away.
Yeah.
But just an amazing person. And, you know, the way we looked at it was you're going to get one shot at a customer buying footwear online. They either decide it works for them or it doesn't work for them. So pushing each other really hard to have the ultimate customer experience was very important. The number one place you went to from Zappos, if they didn't have what you wanted, was Shoebuy. The number one place you went from Shoebuy was to Zappos. And we couldn't never understand why there was so much focus on these two competitors when if you were a department store, an independent, or a cataloger, which I always thought should have been the one to win the game, since they had the data, et cetera. You really should have been focused on yourselves. Instead, we just kept growing the businesses, and fortunately, ultimately, it ended up becoming a category.
How did you get started though? Because you have this idea, it's a category that didn't really exist online. You're going to these brands saying, hey, we're gonna, this is a new channel for you. Like, how did you get the major players to participate?
Being naive and ignorant, and very, very, very passionate. So, and I think we talked about in the beginning, cold calling. We reached out to a lot of brands and basically said, listen, the internet isn't going anywhere. It was the early days. Think about like what you're sort of experiencing with some of the confusion and curiosity around AI today. You kind of feel like you need to be involved with it, but you're sort of scared of it and unfamiliar. At that time, people were hearing about the internet. They weren't really using the internet for their own business, especially in footwear, which was a very traditional sort of age-old business. And in fact, had been burned by technology with my SAP and other things. So they were very standoffish. But our thing was, listen, we can learn together. We'll share all our best practices, et cetera. And if we were from the footwear industry, we would have never done it, because what we were asking for was, instead of buying future orders, so basically the traditional retailers buying like 6 months in advance, what they call sort of future orders, we're saying sell to us at the exact same cost, but we're not going to commit and we're not going to put up any money up front. And you're going to open up boxes in what they call onesie twosies, which they basically had never done before. And send them directly out to our consumer. It's no wonder that probably people thought we were absolutely nuts, but not understanding how much we were asking for in terms of this being a big leap of faith by the manufacturers. One by one, we did convince the manufacturers to come on board. Ultimately, it ended up being an amazing decision for the manufacturers, because the department stores had so much leverage at the time, and this created a completely different distribution channel that gave them much better leverage and power. But also, as we found out, as time went on, consumers like to shop in a lot of different ways. But if you were to have your own website, et cetera, very difficult to put aside inventory. But if you had somebody like us that was constantly pulling inventory, and even though we're doing it one pair at a time, it kind of made their catalog and internet sites profitable. But it was a journey. I mean, thankfully, we got some early adopters, and we just kept very aggressively adding brands. And even brands we got very early would say to us, wait a second, we're selling we're selling 10 pairs in a day. I thought and we'd say, but just look at where we're going, 10 today, but 12 pairs tomorrow, 14 pairs the next day. And ultimately it ended up being millions of dollars for them.
And what was the primary customer acquisition channel? Because it wasn't like you could have Google ads or social networking and influencers, right? How did you go about customer acquisition?
Well, for one thing, we didn't have the budgets. It's one thing that sort of gets me frustrated today a little bit in how much capital companies or young entrepreneurs believe they need to raise. Fortunately, if we end up talking about at all about our different portfolio companies, you'll see they're very capital efficient and are dependent round by round and believe in profitability. But first of all, when we did Shoebuy at the time, it was the .com implosion. So having Shoebuy.com as your name, you weren't going to be able to you weren't raising venture money. We raised I think it was around 2.6 million or so from 58 angel investors. Checks that were between 25 and 100,000. And we had to get to profitability fast. We got to profitability in our second year. But to do that, not only did we need to make money on the first sale, we needed to make decent money. And our customer acquisition had to allow that and scale. So we were very innovative and very entrepreneurial. We did a lot of pay for performance partnerships. We did a lot of really unique partnerships that people say, oh, they would never do that. We partnered with traditional retailers. And we did do things like Google ads, believe it or not. So in the very early days, it was Overture and some other search engines, Akamai and some other things that people
AltaVista.
Probably will, AltaVista, not Akamai, AltaVista, exactly. I can't believe you know. Excite.
Yeah.
But at any rate, you were able to even be very entrepreneurial there because there were no rules and people didn't even understand what the search engines. As it turns out, things like Google were extremely profitable to us because if you were a first mover, we won't bore anybody with that, but there was a lot that we were doing that was based on very fixed payments or pay for performance, where they only got paid if they drove a sale, et cetera. So you could be very, very entrepreneurial back then, but it was a lot of trial and error and a lot of understanding what was generating profitable customer acquisition. But that for us, that ended up being extremely key. We also, to give you an idea, I had heard something in my car one day on some news channel that McDonald's breaks even with their breakfast in the morning. So I came in and said, we're going to break even with what we call platform marketing. We're going to have a different line item where we sell our footwear on other highly visited sites. And that's going to fund the whole business. And even though our organic direct business grew faster than this other channel, which was very important to us, this other channel, which included like Amazons and Overstocks and Sears and
wow,
and apparel sites where they were selling oversized items or fringe items, etc., we would list our products, and that drove a lot of business as well and created a lot of brand equity that we would have never been able to afford to do.
Was Zappos doing that too, or were you?
No, Zappos. So Tony, Shea, there were a lot of very different things in the model, and it would have been very interesting to see where we would have both been today. Ultimately, buying all the inventory and having the largest selection becomes impossible at some point in time. But he really believed in controlling the fulfillment. We had about 800 different distribution centers. He wanted to control the fulfillment, I should say, and the experience. We had about 800 different distribution centers that were shipping product directly to the consumer, which we did at, ultimately, we were at about 99.9% fulfillment, and our average ship time out the door was 1.2 days. So we got very good. But we were really, when you think about it, a technology marketing company. But he wanted, we believed we were creating the experience and letting consumers shop where they want to shop by pure economics, being entrepreneurial and teaming up with all these other sites. He had a different vision, which was much more sort of like almost an Amazon vision, who we ultimately sold to. And I would say he executed perfectly on his model.
Yeah. But you had to then, did you have your systems integrate with all the brand systems for inventory?
So we were extremely good, but we had to do that anyway, because when you think about it, when you think about a true virtual model, we were passing data back and forth literally hourly. So we were seeing exactly what was in stock, and then we'd pass back. We had an item, they needed to pull that item. That's where the fulfillment was so high. So we were seeing what the inventory was. We were letting them know. Then we were shipping. Then when the consumer transacted, you confirmed it in a nanosecond. Then they were shipping the item once you build the customer, and it's going back and forth. So because it was all technologically integrated, or we had to be, it made it actually something that was pretty synergistic to working with a bunch of other larger retail partners as well.
This marketplace model didn't exist. I don't remember 99 companies doing this and drop ship and integrate the future of Wayfair, right? This is ground breaking days of this type of model.
Yes, we did so much. We would just come up with ideas. Now, we're talking about a lot of things that ended up being very, very successful for us. We probably failed 50 times for every one thing that ended up being a great idea, where we were really good at. Here's a Shoebuy, to give you an idea. When I decided to retire from it, we were doing about $200 million a year. So it wasn't $1 billion a year that Zappos was doing. But we're doing about $200 million a year with about 190 employees, and that was including customer service and warehouse. So we were worker bees, and we were extremely analytical because we didn't have the affordability to have too much ego that we could go into too many rabbits. So everything we were always testing and trying and experimenting. But in using really the key metrics as sort of our compass, we did come up with a lot of sort of fun ideas, and it was the Wild West. Nobody really understood, even hiring people. There was no experienced people in internet marketing or even developing a lot of these technologies in even the customer interface, or even doing things like payment methods or retargeting. It was all, you were making it up as you go. But that's what made it so fun. And the fact of the matter is, it's no different now with any really disruptive, innovative business. Sometimes, like I said, it's better not to know. But when we did find things that were working, we doubled down and tripled down and quadrupled down. We went to 10. If we saw something like when we experimented in selling on other sites, I would call everybody. I went to the Internet Retailer 500 at the time, tried to partner with every person we could be selling shoes to. Some turned out to be great hits where we would sell 10 pairs a day. Some ended up being huge successes. And we also, on the marketing front, going back on them, I wouldn't leave the office unless I called 10 what I call business development deals a day. And some turned out to be not that great, but ones that really worked, then we went after everybody that was anything related. So we did deals with Priceline, or we did pay-per-performance deals with Yahoo, or we went we got Dole Foods to put us on 10 million point of sale displays and put us something in what they call fruit bowls for the busy mom on the run, and you could get $1.50 off at Shoebuy. And we paid them, I think we paid them $1 bounty. So you're talking a $2.50 basically customer acquisition cost, which we do all day long. But anytime we saw any of these things that clicked, we got very excited about, and we used them up until there was nothing left in terms of calling everybody and their brother that could be a similar deal.
Founder-led sales.
Yes,
Right?
very founder-led sales. We did
OG.
become very, very good internet marketers at the same time too. A lot of affiliates, a lot of things that still exist today. It's just we tracked to the key. We had hundreds of thousands of keywords. Where we were different, and even different than some today, is we never accepted anything on the, let's say, a campaign level. Everything was down to a keyword level. We looked at we knew where every item was being sold, what was direct, repeat, organic, or coming from, and everything had an associated customer acquisition cost. And we made sure that we were always staying in what we considered a customer acquisition band that was acceptable to us. And if anything wandered outside that band, we killed it immediately. If anything was outperforming that band, we tried to find everything that we possibly could find that was similar, that was generating a similar customer acquisition cost.
Okay, what do you remember as like the colossal failure? Oh my God, we put so much time into this and it just flopped, or like something along those lines.
Launched a series of vertical businesses. Interestingly, they were accretive for different reasons at different times, but ultimately, we did something in the flower business. It's really hard. So we tried to bring what we were doing, and we launched it, and we were selling a lot of flowers. It's hard to make a lot of money. Looking back, we launched a series of microsites. Wayfair used to be called CSN stores. There was reasons why that made an awful lot of sense back in the day. In fact, Nirka and Steve Conan would tell you that it's probably one of the big reasons they were able to build such a big business scalably early. But ultimately, the search engines got a lot smarter, and duplication of content, et cetera, and you could get punished. But for a series of reasons, you have to evolve. And looking back, some of those sites, I'm sure never made us a whole ton of money, but there were so many things that I think the good news is I really did not hate failure at all. What I would have hated is if I didn't think we were taking very smart shots on goal and seeing them actually perform, having performance validate that we were taking the right number of shots on goal. And that includes taking big bets and doing a lot of singles, but lots. So if I thought about it, there's so many different things that we did that were failures. And I would say probably the vast majority, or maybe over 95%, came out of my office and were my ideas. And where it was very funny, if you looked at the Shoebuy metrics over time, we went profitable really early. We were growing 75, 100% every year. Even with aggressive new customer acquisition, our repeat buying went from something like 16% to 28% to 31% to 36% to 42% to 48% to 55%. Our average order size went up every year. We kept making more and more money. In fact, through the economic recession, we tripled revenues and grew bottom line faster than top line. So, but if you looked at it and you'd say, well, geez, it's like you guys, somebody's whispering in your ear and you're seeing you have some sort of crystal ball. Really, we fail. It looked like that, but we were failing, like I said, at a magnitude of probably 10 to 1. We killed failures very fast based on really listening to the customer and listening to the metrics. And we again, doubled down and tripled down on those things that were working. And we always were very married to the customer experience. We never changed our value prop, which was to have the largest selection in the most convenient manner at extremely competitive prices. It was that we never changed.
So how did the deal with IAC come to fruition?
We haven't talked about it. It's not really relevant, and or anything. We were a very sort of quiet shop, but we got 3 offers at the same time from 3 really good buyers. We had 58 angel investors, and we had a bunch of absolutely amazing employees. I mean, to give you an idea, when we sold the company, every single person that was hired originally for their roles, and everybody in our what would be considered management or executive level were the original people hired for their roles. We had just amazing loyalty, and I kind of looked at it like if you have 3 people trying to buy you, that's the right time. And these things are a lot better bought than sold. And everybody was going to get make an awful lot of money in a very fun way. And we had a guaranteed, which we also didn't advertise, but I had negotiated that they couldn't move the business 60 miles outside of Boston. And every single person retained their role, and actually most got better roles and higher pay. So when IAC, and I also believed in the IAC sort of mandate at the time. He had a bunch of, it was run by an individual, Barry Diller, who was extremely bright and had a series of different, what we considered very synergistic other businesses. And if we could sort of bring them together and leverage the intellectual property and what we know from our own customers, et cetera. So if you were if you were moving to a new city and buying a new home on realtor.com, and you were going to get your first date since you didn't know anybody on match.com, and you were going to get new shoes for that date from Shoebuy, it all made an awful lot of sense to me. So for a variety of different reasons, that's why we sold the business to IAC. And I ended up actually even saying 5 years post-sale, and I think in fact, in thinking about it, until I retired, every one of those executives I mentioned stayed with us. So we just kept growing the business.
Yeah, and it was this gem in Boston that just continued to grow. So I was running my search firm at the time. I would have to double check the dates, but I think it was after you had moved on, because Mike Sorabella was the CEO then. And Jim Keller, was your CMO, if I'm correct?
Yep,
right?
Exactly right. So we brought Jim as our first CMO, who did an absolutely wonderful job and is CEO of one of our portfolio companies in the venture firm I have now today. We did not have Mike Sorabella was our first CFO, who, when I retired from Shoebuy, ended up becoming CEO.
But you met him through your Bank Boston days, right?
Yes. So Mike Sorabella was one of the many employees of Craig Starville. So I worked a lot closer with Craig. But yes. So yeah, it was fun. I mean, it was an amazing team.
What did you learn during that 5-year stretch when you were still part of the IAC group? Because I would imagine you were probably talking to the other portfolio company CEOs and learning from each other, and Barry Diller and
a ton. If I wish I had that way better than in any form of MBA. If there was one takeaway, if there was 2 takeaways. One, there was a lot we were actually doing very well. So, interestingly, Barry Diller makes things sort of very transparent amongst the different businesses. And is very good about recognizing not only sort of the different key performance indicators, et cetera, but really breaking it down and understanding where the different businesses are succeeding or failing. For our small little shop with such big businesses under that hood, Home Shopping Network, Lending Tree, Match.com, etc., there was a lot that we talked. Revenue per employee. I don't even think we had one litigious thing. We had, but I don't know if you remember Net Promoter, but customer experience wise, etc., we were way on the top, which surprised us. And customer acquisition costs and so many different sort of metrics. So there was a lot that we did really, really well. The biggest takeaway I had, though, is we could have played a lot bigger. And when it's your first real business and you're very protective, and we always sort of liked the notion of growing top line and bottom line even faster, I saw some really incredible things and some really incredible entrepreneurs that built some wildly big businesses. So probably took our risk, I would say took our risk appetite and times it by 10. And I think there's ways to take a lot more smart risk. Would have been fun to go back. And actually, and Tony Hsieh with Zappos, I think, was another one that pushed things a lot harder in the sense of if he wasn't going to create something that was going to really be transformational, it wouldn't be worth it. But at the same time, Tony Hsieh had done a business that I think it was called Link Exchange or something like that, that he sold for $230 million coming out of college, basically.
Right. Yeah, he had the risk.
And Woody
risk
Fairguy and
appetite.
others, they had, and that's why sometimes these ones that have initial success and learn from that same way I learned from being part of the IC family. You can put what we call gas and brake. There's a lot you can be doing in terms of you can playing bigger.
So what led you down the path of being an investor?
A bunch of offers from VCs in town. So that got me, that naturally makes you think about it as one opportunity. I was really thinking about just sort of disappearing. But there's a lot of good guys in town. Same time, I had an idea on buying a company. People told me it would be very difficult to put together the capital to do the transaction I was interested in, especially if I was going to be CEO. I was going to put somebody in and serve as chairman. As it turns out, I raised the money very fast. So that made me realize, okay, there is fortunately enough believers that are willing to, so if I did want to do something that I have, at least I have the optionality. I learned from that process, I didn't get the company I was trying to buy. It was actually a public company. Word got out, it traded way up. But I realized having committed capital would be, even that small intersection between not having committed capital and raising capital can create a lot of friction in terms of taking advantage of an opportunity, since markets are pretty efficient. These things don't last very long. And I also kind of looked at it and said to myself, you could do another, and I'd done that. So you could do another business. There's a lot of charming people. You could, and I was doing that. You get calls from so many of the private equity firms in town saying, would you look at this business with us? We'd love for you to weigh in. What do you think of the model? Can you help, in terms of looking at
Do you want to be CEO?
Metrics? Yeah, being on the board. Or you can do nothing and it all these failures and life experiences that you learn so much from, you just go away. And I wanted to give back. I also wanted to have fun, and there were a bunch of people in town that I really liked and admired and was very friendly with, that I felt like were in the same boat as me. So I reached out to a series of them: Steve Papa, Lars Albright, Len Schlesinger, Diane Hassan, Colin Engel, just a bunch of amazing entrepreneurs, and said, listen, I'm thinking about doing this. If you guys do it with me, then this could be a lot of fun. And then we're giving back and we're creating a lot of companies like we had done with our own individual companies. And if they didn't do it, I probably wouldn't have done it, but they all sort of saw what I saw. And that's what's made it just such a total pleasure. And that's how Data Point was born, really.
I'm honored to say 4 out of those 5 people have been on the VentureFizz podcast. So,
Which is the one that has not?
Len.
He's amazing. So amazing. So I don't know if you know, he was vice chairman, CEO of Victoria's Secret Limited Brands. It's an incredible story because probably the only one that was a very tough CEO, and yet you can see he was kind of a consigliere in that business, and with a lot of different things. He lived through that whole entire moment. He was CEO of Von Pond. He was president of BAPS and did an
I
incredible
remember that.
job.
Yeah. Hmm.
And is just beloved and sits on incredible boards and has had incredible experiences, Demandware and a bunch of others. He would be definitely somebody, he would be 1,000 times more interesting and smarter by 1,000,000 times than having me. That's for sure. And we have a bunch of other, Gail Goodman, I don't know if you've had on.
She's
and
been on, yep. Hmm.
Peggy Koenig, who did Avery, that people don't realize is probably one of the most, besides Abigail Johnson's probably our second most successful woman in finance. She did Avery, which was about $80 billion and 500 companies. Just so many fun ones if you look at the ones that are involved.
All right, so let's talk about Data Point Capital. So what's the firm all about? What are you targeting for investments?
So we're very unsexy, so it's easy to talk about how we target. And we're an easy mark. So when I say our criteria, if you fit our criteria, we're here. I know always hunting, and have lots of dry powder. So, but it's really 3 things. One, we try to only invest in things where technology is a prolific growth driver. So we don't do traditional retail or manufacturing. We do what we sort of think about in 2 categories. One, consumer tech, which is like e-commerce, marketplaces, platforms, and enterprise tech, AI, IoT, machine learning, cyber, a lot of very typical software as a service. 2, we really like capital efficiency. We wanted to be we found is when there's great alignment and our founders become exorbitantly well, we do extremely well. So we don't want them playing round around. We don't want them, and we really want there to be a path to profitability. They raise very little money, et cetera. And 3, we like it to be that we can have really strong conviction on their ability to scale. So even though we invest early, we're looking for you're making money on the first sale, your customer acquisition scaling, you have real margins, you have very low churn, you have Salesforce productivity. So in our minds, the train's really leaving the station. And those 3 things we have found, we haven't had a single wipeout in 10 years. Our average company, to give you an idea, our last fund, every single company in that fund we either sold or is taken public or has raised a substantial round led by new investors, and we returned, I think, one of the top 5% for distributions per paid in capital. And the average company in that fund has grown 2 times a year on average post-investment. Our current fund, same thing. And a single wipeout, our average company has grown 3 times a year post-investment. And we think that it's really because we're not smart enough to be prescient. It's really following this discipline, which we've stayed very, very married to.
Well, there's lots of, if you go to your portfolio page on your website, there's lots of companies that have had an exit, and there's companies that people may recognize, some maybe not, but the ones that certainly stand out, DraftKings, Rent the Runway. So how did you get involved with those 2 companies?
Yeah, so Rent the Runway had reached out to me, their venture, so going full circle, or at least related to some of our earlier discussion, Bain Capital and Highland had invested in Rent the Runway and wanted me to be on the board before from the relevance of Shoebuy. So I met with the CEO, et cetera, and different aspects, I was not in love with their model. As things transformed, I became much more excited about the business. DraftKings, we looked at it, $10 million valuation, a $40 million valuation, and a $100 million valuation. And there was just a series of things we couldn't get comfortable around. As it turns out, and it was not a capital efficient business to start, but the management team was unbelievably brilliant, incredible executors, and everything that they sort of mapped out. And when we saw the business at an inflection point that we believed was now truly scaling, much better loyalty. You weren't jumping back and forth between FanDuel and DraftKings, whoever had the better promotion, payback period much quicker, 10 million members and growing loyalty and average order size and time on site, et cetera. And we ended up reaching out, and I got together with Jason Robbins and said, now the time is right. And it ended up obviously being a absolutely wonderful story for us and for Boston. But lots of fun ones. People don't, the fun thing about this business is lots, our first couple investments were in a couple teeny companies when we started DataPoint Jebit, which was few guys out of BC that left BC with 1 quarter left or 1 semester left to graduate. Not something I would tell them to do by any means. We did that, I think, at a $4 million valuation. The CEO, Sean Coburn, was just a really big years, really thoughtful, and we ended up selling that, I think, for like between $100 and $150 million to private equity. We did a company Clipped. That was like the second investment in the programmatic space. Ended up being a really difficult space. I think we did that at a $4 million valuation. We sold it for $100 million or so, or between $100 and $150 million to a very large public company. And then a lot of fun local stories. So, but the best is when, these businesses are very similar to sort of Shoebuy, that everybody hates them, no one cares. And you go underneath the hood and they're really hidden gems, and the management teams are really exceptional. We did one, to give you an idea, we did a company Resident that we even thought about internally here. It was in the mattress space. It was the last entrant. Tuft Needle, Purple, Casper, there were a bunch of others already. Some of them were losing $100 million a year, so it looked like it'd be a commoditized race to the bottom in the online mattress space. And they had raised, I think, $200,000 in a loan that they had already paid off. And we invested in that. In 6 years, that company ended up doing $1 billion in sales and $100 million profit. And we sold it last year to Ashley for $1 billion. Seeing ones like that where they just are the execution's so strong and they're so innovative and they're so entrepreneurial. And it really is across so many categories that are non-intuitive. We have one in the called Kava Design, for example, that's in the customized furniture space, which is direct to the consumer. And we looked at a bunch of those businesses. And if you think about coming out of the low interest rate period, now we're back to a time when hopefully interest rates start really going down again, although we still think of them as pretty historical lows. But going through tariffs and the hangover from COVID of people doing at-home projects, and you've seen sort of the roller coaster with Wayfair. Yet that business is going to do between $150 and $200 million this year out of nowhere, and is profitable and is making a lot of money on first sale, and is so extremely transformative. We did one recently, which we didn't expect, but very quickly, not only did it really take off, and we literally did the business, I think 6 months ago or so, and they're about to close another round that's significantly higher, but they did in the first year of them launching their marketplace about $1,250,000 in traded volume. And it literally just keeps going up. It's in the prediction outcome space. There's just so many of these fun ones. We did one in the on-demand marketplace for painters. Mm-hmm. People just didn't get it. We ended up loving the business and grew 800% in 2 years. We sold it in 2.5 years to PPG, a large public company, returned about half the paid-in capital of us fund at the time of the sale. Wow. Just a lot of fun stories.
That paid then, right?
Yes.
Was that a Techstars company or
No,
am I?
Jether was a Techstars company.
Okay.
Um, but Painsign was a really fun story because the founders actually had done a business before. They were very successful. It was another one that you're talking about, a very virtual business. It wasn't like painting fine art, it was painting your bathroom or your children's room, etc. But you could get, if you ever went through that process, you would call somebody, they would finally come out, probably didn't come out the first time, you call them again, they come out, they walk around with a clipboard, it takes 3 weeks to get a quote. This, you got a quote within literally instantaneously. The painter showed up the next morning, fully guaranteed. And painters don't like to advertise and do all the business function parts of that business. They rather hold the brush. It was just a perfect, marketplace, and ended up being very, very successful. So it's just so fun seeing how entrepreneurial, how many of these businesses, in a Rent the Runway or DraftKings, I mean, they really have transformed. And just watching these entrepreneurs become so successful, it just makes the whole thing fun. There's no question. And I could go on and on. The other thing is the local part of it. If you think about it, just a lot of fun local companies. We did one in JobGet. I think we did that at less than a $10 million valuation. It's now the largest online job board in the country. They ended up raising it substantially around over 40 or 50 times where we invested. But that was a young kid in Boston. His parents were immigrants. We have another company, Black Kite, in the cyberspace. Unbelievable execution.
Yeah, they're killing it.
$40 million or so in ARR, and just such a spectacular job they're doing. To think these are all Boston companies. So if anyone says Boston, there's a lot of fun things happening here for sure. We did one that was kid out of MIT, Raptor Maps in the solar analytics space. He just raised it, I think, over 10 or 15 times where we invested in his, I think, just past 10 million or so in ARR. Just a lot of really fun, different businesses.
You talked about Clips, so Josh Summers, right? That's an example of a repeat entrepreneur that is now, seeing the evolution, the platform shift to AI, and now swinging with Enfi, right? Like I'm seeing, with 7AI, the founders of Cybereason, doing it again, AI platform shift. Maven AGI, three incredible entrepreneurs coming together to form that company. There's just so much going on. And Boston is so humble, it just kind of flies under the radar and does its thing. But I'm like, we need to make some more noise of all the really, really good companies, especially in consumer too. That's the other category that just drives me bonkers. People are like, there's no consumer companies in Boston. I'm like, have you really looked?
Yeah, I mean, in a weird way, so not to be controversial, but I've always been very, very quiet. In fact, frankly speaking, I mean, one of your superpowers is you're extremely likable. You and I saw each other at numerous things, and I didn't want to even do the podcast. We really
Yes,
do.
I remember.
Our portfolio companies are the stars. Boston, what does the noise really mean? I mean, a lot of times noise can create a lot of hype, a lot of false sense of security, and a lot of problems. So we're very humble here, but we're very, very successful here. And you're exactly right. I mean, look at, the car gurus came out of TripAdvisor. That was one of the founders. Colin Engel's doing another business right now.
Yes.
Exciting and is in our portfolio.
Steve Papa and funding his team to do
amazing.
Toast.
Yes, and Steve Papa, people don't realize, was part of the founding team of Akamai. And then
Yes.
So
and then the
and look
company
at
he's
Lars
doing now
Ulrich.
is so successful, and no one knows what he's working on now, and it's just it's incredible.
No, because they stayed, like you said, very quiet. Lars was part of Quattro and Session M, two wonderful outcomes. And as a matter of fact, one of his executives is one of the co-founders of Josh Summers' new company. So, but if you look at,
Scott
I
Weller.
hear the same things that you hear, and let's say we even look at just consumer, for example. I mean, Wayfair, DraftKings, TripAdvisor, CarGurus, Woo. Plus, nobody seems to pay attention. There's things like TJ Maxx and BJ's Wholesale Club and Dunkin' Donuts. And by the way, what about Fidelity? So, like, we do great.
Massive.
And and it was a wonderful place to do Shoebuy. So, what is the noise? So we are very quiet, but maybe we have to think of that as one of our really big strong suits. Now, I will say we do invest all over the world, and we do invest all over the country. The one place we typically don't do a ton in is the Valley, because it makes it 3,000 miles to us. Plus, it's hard to find our ethos. But there are times where we could say we're a little protective, and I think I talked about it in the beginning of this. I could have gone even much, much bigger in some ways. And I think there's more that people that probably share more characteristic of the way I was, that, you're really watching bottom line. And, so you kind of, I think there is a balance, and it would be nice to sort of merge some of these different cultures in some ways. But kind of like our culture here too, so it's probably 1 out of every 3 investments we make, but still 1 out of every 3. And if you look at it, basically, if you look at venture investment or even outcomes, you have the Valley, which is by far, that it is what it is. And you've got, and there's like LA, but there's then New York and Massachusetts neck to neck, and they really are neck to neck. And we love New York and have had a lot of success there. And we really think of that as sort of like a neighboring city, which it is. I mean, so you can jump on a train and be there in 3.5 hours. But they're almost exactly the same in amount of deployment of venture capital, and they're almost exactly the same in their number of exit, and if you look at exit value. So basically, and then if you take, after New York and Massachusetts, everything falls off a cliff. We love the undershot regions, Ohio or Virginia, or, but everything falls off a cliff. So I think we're doing pretty good. And it's a great place to start. It's a great place to start a business. And there's all the things everyone always, gets attracted to debating, cost of living and people leaving. But we have all these other wonderful things, and it's created just a significant amount of value creation. And even in the venture capital world, if you think about sort of the, birth of venture capital, it's been a great hub for that. So yeah, we have ones going to the West Coast, and frankly, there's a lot of venture capital firms, period. But I think it's just pretty exceptional. And people forget to, companies like Klaviyo and HubSpot and Wayfair, these are not small companies anymore. If you look at it from a valuation perspective, DraftKings, I think, is at a $15 to $20 billion valuation by itself. And these are not small.
All right, so AI is on the radar for every investor. How do you look at AI? I mean, you talked about the criteria of what you look for, but are there pockets that are of particular interest that maybe you're kind of more looking at than others? And how does that, affect in the world of this AI platform shift?
We're looking at all, but just like cyber or any of these different things, we have to, we like the way we play, and we, like I said, like capital efficiency. So it's solving too big of a problem, or it's too broad of a mandate. It's not going to be productive for us. But I will say we're always very enchanted by AI, and yet so many of the things that people got excited about through the years, when you went under the hood, weren't really truly AI. So what I will say right now is, for the first time, we are really seeing the use of AI. I mean, all our companies use AI. I mean, in some of the most obvious forms. I mean, if your coders are using AI now, there's no question. And your customer service, et cetera, and your design. But it is here, it is very real, and we're just, we're looking at a lot of companies constantly. Interestingly, what is an AI company? I mean, they're all in some form or another representing themselves or presenting themselves as AI, because AI is a very sexy thing right now. So it's just really determining what problem are they solving, are they executing on that, and looking at it from the same lens we look at any of our investments, which does mean we miss out on some of these big, wild, dreams where they're pre-revenue and they're going to change the way we do everything. Those are the ones that there will be some winners, and they might not be in our portfolios.
All right, so on your website, you have a list of special advisors, and a lot of the people you mentioned are special advisors to Data Point Capital. All these people are extraordinary, but there is one person that I have to ask you about. So how is Leonardo DiCaprio a special advisor to a VC firm in Boston?
By the way, the Leo, so our special advisors are very, very real. We won't, first of all, we make up about 30-40% of our committed capital. So we all write checks. So we're put our money where our mouth is. We don't like making money off of fees. We want to make money off of returns. So try to have it be that if we lost money for our investors, we would lose money. But they also take board seats and evangelize deals and help coach the teams. And it's just so many remarkably fun things. In fact, we talked about Clip. Lars Albright was on the board of Clip from the very beginning till sale. Diane Hessen's winning that job yet for us that we talked about. John Giuliani did Yieldify, which as chairman, that was one of the companies we sold the last couple of years, all cash to Publicis. Leo DiCaprio was an investor in Data Point through either family office advisor or whatever it was. And then he became very excited about it. I think it was, you were seeing a lot of this where people, even from the celebrity front, were getting much more active in transformation of technology and technology investing, et cetera. And we're still seeing more and more. And Leo has had an amazing run and impact and staying power. The fact that you mentioned that in itself has pretty good value. But he was doing a lot with clean tech and other things. So we spent decent dialogue on, we're very, the way we look at investments, and interestingly, we have some very fun ones in what we consider, sort of clean tech, whether you look at Raptor Maps or Box Power, et cetera. But it's not where we're necessarily trying to be. So there was a lot of sort of debate there. And also, we don't want it to overshadow other people, because a lot of these guys are very quiet, but are unbelievably successful and entrepreneurs. We decided, since he wanted to, and we were sort of like, this is a pretty, how often does that happen?
Right, exactly.
We made him part of the team. And it's funny, everybody finds out how to be very helpful in different ways. And he has his different ways. Do I think he'll take a lot of board seats on our companies? No, we would love to find the right one. But we'll see. Except I will say my daughters were very excited about him being added on as a special advisor. So that in itself, if you can
cool dad moment
your children in any way, especially right. If you're kind of a nerd like me, you
right.
that I'll take it for whatever it's worth.
Right. I know people. Sure, Dad. Yeah, right.
I will say this too. When I'm flicking through the channels, he is an amazing actor. We also, by the way, he has continued to be relevant and succeed through a lot of transformation in what we're seeing in media. So we felt like one of the categories we looked at is social, et cetera. And it'll be interesting. We have not done something in the social space. But there's a lot, that medium or in video. We looked at one recently that was AI in the film business. But it's incredible that to be able to last through a couple decades in that market and still be top of your game. It says a lot. So we do think there's a lot of real value we ultimately be able to provide in insight. But I will say, when I go through the channel, when I'm flicking through the channels and I come across one of his movies, he's a very good actor. It's amazing.
Amazing. Like,
His movies.
I mean, it's every movie is always like extraordinary. Like
It's amazing. The acting ability is incredible.
yeah, like consistency of choosing the right films too. And obviously he's got the pick, I'm sure, of what he, like him and Brad Pitt, they can pick, right? But it's just the consistency of still picking the right ones. It's like picking companies, right?
Yes, in true quality and real. I just saw that Bob Dylan movie with Timothy Chalamet. I thought it was amazing. And now I heard his next movie is amazing.
Yeah, everyone's talking about.
I never thought about that, but some of these guys know they're not only incredibly talented, but they pick the right bodies of work. That's for sure. So that was kind of the things that excited us about it. And then at the same time too, you have to experiment a little bit and see, is there other areas of talent that we should be tapping? I would say that what I have found is a lot of these quiet entrepreneurs are just, the value is just absolutely remarkable. The Dutch Bondays of the world that people might not remember, but did Cascade Communications in Sycamore, and I think at one point he was the richest Indian in the world. And just that mindset, it's just, that's the value is just, and they are repeaters. And they impact a lot of these guys. So you see that sort of glamour of a Leo DiCaprio, but it is amazing. And the one part I think you didn't go there, and I don't know why I'm putting myself in, going into a negative on myself, but the one thing I don't regret anything with Shoebuy. I thought that was a really fun run, other than a lot of these guys too. I mean, it's amazing the amount of businesses, and I think you alluded to this, have been launched from their employee base. So the Shoebuy employees never left, and there was amazing loyalty. But some of these guys have fostered innovation. If you look at the iRobot Mafia, the Quattro Mafia, the Mafia,
insane.
There's a lot of businesses that have come out of this business.
Cube.
Unbelievable.
Insane. M-Cube.
Insane. And a lot. I mean, I don't think people realize. And great success stories. So.
Yeah, and Desh Despandi, I mean, there's reasons why things at MIT are named after him, because he's just so insanely successful
and incredible and amazing, and could do it again. And you could take a Dash and put him in the middle of nowhere with not $1 in his pocket. He would do it again.
Yep. All right, 3 apps you can't live without. Can't be email, Slack, or calendar.
Well, for one thing, I think I could live without any of the apps because I have before and I did just fine. And I'm not even that married to, as you know, things like social, etc. I don't do Twitter or Facebook or Pinterest or Instagram or anything. But ones that I would have trouble, that I'd be a little bummed. Uber, I don't know, calling a cab company, I remember, where they answered all gruff and like, woman had been smoking all day and she answers on the 21st ring and mad at you. Uber, I really enjoy. I like UberX. I like so what else? LinkedIn, but I could live without it. I did work yesterday, and finally came home for the second half of the football game, and my 13-year-old son and I put a $10 parlay on DraftKings, and if Zay Flowers would get a certain amount of yards in the second half, and Aaron Rodgers was
no way
yards, and we won I think $60, and we must have run around the house bragging, and we won $8 billion. So from an entertainment standpoint, in my Starbucks, I do use the app. Even though I like Dunkin' Donuts better, but I use the Starbucks for coffee. But I use the Starbucks app every morning, and I really love it. So there's some fun apps, but that's about all I got for you.
Like honestly, with the DraftKings thing, like I have like $5 bets on these games. It's as if I have like my life fortune. And I'm like, no, why would you not score that touchdown? Like I'm just like freak out. Or if you win, you're just like, yes, greatest day ever.
$3.
It's
But it's
what,
so,
$3?
it's very, very, we have very big LPs, so you don't think you're crazy.
Yeah,
Same thing. They tell me
yeah,
they joke around $2, $3, but it just, the fantasy, I think it's so funny.
it's
But,
funny.
and you can see, by the way, I mean, why the engagement levels and why it's so important to sports. I mean, game can be 35-0 and you're still watching, you're
Right,
to the
totally.
end.
All right, what do you like to do for fun outside of work?
So I do a lot. I want to live on 500, although I'd be overstaying my welcome. But um, and even though I'm a worker bee, there's so much so I love anything with my kids is the best. I like to travel. I love skiing. We talked about a little bit Colorado. Pickleball now. I love movies and reading and yeah, there's so much, and I wish I had more time. There's so much more I would even be doing if I so many things on my to-do list. So, um, but yeah, and being with friends or dive bars or um, yeah.
Cool. Well, Scott, thanks so much for taking the time to walk us through your background story. And I was persistent because I'm like, Shoebuy needs to be told. That's a story that needs to be out there. And obviously all the great work you and your colleagues at Data Point Capital are up to, and obviously everything else you shared along the way.
Well, you're really nice, and you would say that to me, and I think I'm really a dinosaur, and I'll probably
No,
be the least interesting of the guests, but this was fun actually, and it ended up being a lot of fun. So you got let me go back to some very fun memories. So I appreciate it.